Hi, welcome to Cambridge House Live. My name is Jonathan Roth. I'm here with Danielle Park from Venable Park Investment Council, and you're also the author of Juggling Dynamite. Thanks very much for joining us.
Right, my pleasure.
I want to start here by coming back to a few things that you've said recently. You've been saying that we are right on the precipice, if we're not already there, of some sort of global recession. That, you know, we were in one in 2008, came out of it a bit, looks like we're maybe going there again. You're pretty clear in terms of what you're writing that we are there. Unpack that for me a bit.
Yes, I think it's a synchronous global slowdown. You have many of the countries in the Eurozone already in the classical definition of negative quarters of growth. You have the UK there, Japan's there, and the data is just that there's no such thing as decoupling. So the incidence of downturn in those economies is 70 to 80% correlated with North America. So I think that although it hasn't shown up in negative quarters yet on this side of the ocean, that it's very much in the works, and we may find, you know, retrospectively 3 months from now, I think we may find that we were actually entering the downturn, so to speak, in North America right now.
So what we saw on Friday, the worst day in the stock markets in the United States this year. Mm-hmm. So this is what is this? Like, do you think this is like we're literally going over the edge right now? Or you think this is just kind of a signal and we've, you know?
Well, the stock market's supposed to lead, right? It's supposed to predict this cycle.
Sure.
So it's supposed to start down about 6 months before the recession is clearly recorded in the data, and then it bottoms a few months before the recession ends. So you tend to get about, we've had a very significant sell-off in the last couple of months. I think it actually started last fall. So you know how we were into a significant downturn, more than 20% in most of the world indices last fall. Then you got the LTRO injections out of the Eurozone, which kind of created this euphoria again of liquidity in asset markets. And so we had a few months that kind of broke trend in terms of the stock market. But in terms of the actual data on the global economy, we really didn't have any substantive recovery there. We had a slowing, we had, jobs growth is falling off again. All the PMIs in the world have been contracting over the past many months. Housing, most of the things that give us any help on the leading side of the prediction aspect have all been negative for several months. So I think the stock market lately has just come back down to earth in the sense of liquidity pumping is coming to an end in most of the world's economies, and we're back to what kind of growth have we got? Oh, slower than we'd hoped. But it's all a natural, healthy part of the correction mechanism.
Right.
And I think that that's what I try and, actually, it's not a doom and gloom thing to say, I think we're into the third recession, because in a delevering period, like a secular bear is brought on by excess leverage, and you start into it, and every 3 years or so you get a recession, and then by the end of 3 or 4 of those, you get everything sort of cleaned out of the system. So it's actually progress, and I think that we may get another wonderful entry point on assets in the next few months. It could be anywhere from 3 to 12 months from now, but at that point you'll get better dividend yields, you'll get better valuations, and you'll have less capital risk because prices will be more in line with long-term, fair value.
So in a way, this second go-around that we may be about to enter into here, sovereign governments are not going to get involved this time because they simply don't have the capacities to do that, and you say this is a good thing.
Well, they shouldn't have done what they did the last time, right? They were
may have delayed the inevitable.
We'd have been so much further along in the healing process if in 2008, Barack Obama had come in and cleaned up the mandate he was given to say, go after the bankers and put back Glass-Steagall and tidy it up, basically. He didn't do that. Most governments in the world didn't do that. They said, well, that's one thing we could do, or we could just pump in a bunch of liquidity and hope for the best.
Right.
Well, they did that. They wasted an awful lot of good money after bad.
Yeah.
And it's like, look at the LTRO in the fall. €1 trillion went into the Eurozone banking system, and then they told them to turn around and buy bad bonds to help support the sovereigns. And then they lost a ton on the bonds, so now they're undercapitalized again. And there's only so many times you can take $1 trillion and toss it at these things. It starts to be really significant and negative for the economy because you've got austerity everywhere else, right? Everybody else is supposed to be putting up with less and cutting benefits, cutting entitlements, and at the same time you got the bankers saying, but don't cut anything on this side, like we still need full support backed by all the taxpayers. So you're kind of killing the economy with every fresh wave of stimulus, and I think that's why there'll be less appetite for that in this downturn. just less money, but also less political will, because all those governments have got fired, and they continue to get fired for putting austerity on the people, but liquidity into the banks. I think that will now be seen to be not a great policy, and we'll get back to the business of trying to put infrastructure in place, right, to get the global economy back into recovery mode.
Moving. So, a situation like Greece, if Greece leaves the euro, which I think, what's your take? You think they're going to leave, or you think they're going to figure this out?
They should. I think maybe the Germans will leave. If you were the only person in your family that was making money and living within your means and saving, and you had a bunch of spendthrift folks that kept asking you for handouts, at some point you'd say, you know what, I'm going to leave the family because you guys need to be grown-ups and look after your own stuff, and I can't afford to keep bailing you out. And I think that either the Germans will go back to a stronger currency, something like a Deutschmark, and the other, the weaker countries will be together, but they need to devalue their currency to get back some competitiveness, and I just don't see the current structure as sustainable. So I hope they admit that, right, and get back to the business of, letting their currency get weaker, using that as a healing mechanism. We've been through this so many times in human history. This is so typical.
Not a new story,
it's not a new story, and we keep thinking we can, make it different this time by wishing hard and wasting more money. But really, the world needs to conserve its resources now, I think, and get a lot more efficient. And that means writing off bad debts. That means they do have to cut some of the entitlements because people have come to expect too much. In the credit bubble, everything was affordable, right? And now when the reality is you can't get more credit, everyone's behavior and choices gets a lot more accountable. And I think that's really healthy, and we're there now. We're starting to go into that phase where it's you can't get more credit, so how are we going to restructure this so that we can make the economy still survive?
So do you think a guy like Mitt Romney, if he's elected president in November, do you think that has any bearings in terms of how are things going to get fixed under him, or do you think they just continue down the same road we're on, in the United States particularly?
I don't think it's going to make any difference. If you hear, the man has no credibility. I have no interest in either political side of the spectrum because they tend to be very antithetical. They're very extreme in their positions, and one tries, like I heard Mr. Romney this week saying that this president has, ran the economy into... If you really are buying the idea that Barack Obama ran the economy into the dirt in the last 4 years, then you're in some kind of, myopia that you don't see what happened. Right. The history of credit cycles is such that there is always a boom, a great inflation trade where everyone takes away regulations, the policymakers all make it easier for the lenders to lend, and it comes to a crescendo where the thing blows up. That happened, by the way, already in 2007, 2008. It's not that the economy is going to blow up. It already blew up, and now it's just it's hard to admit the mistakes. Right. And so I think either political party is not going to have the chutzpah to do what's needed here. I think one of the important things that may happen, though, is this automatic fiscal cliff that's kicking in, because both parties said, well, we won't cut spending, well, we won't increase revenue. Well, there's a mechanism now in place that if you can't agree, you're both going to lose on either side. Right. And that's probably...
They're fast approaching, very quick.
It's probably a healthy
January
thing.
2013, right?
Yeah, it's probably a healthy thing because no one wants to do the right thing. This way they'll be forced to do something they don't want to do on both sides of the aisle, and they can say, well, it wasn't our fault. Right.
Okay. Now, quickly, I'm going to move over to China because you've never been enamored with China. We've seen a bit of a, it's gone from 9-10% growth now. It's sort of like 8.2, somewhere 8.3, somewhere around there. What's happening in China? Are you still pessimistic about the situation there?
Well, basically, my thesis has been, and I had it in 2007, 2008, that the credit bubble, if you overlay the credit bubble, the incidence of credit creation in the world, the swaps market, all of it, right? You got to about $1.4 quadrillion worth of leverage in the world at the peak in 2007. And if you took a chart of the Chinese stock market, of the price of copper, of the equity markets of the world, basically everything, you overlay it on that credit bubble, and it peaked in crescendo in 2007, 2008. So my point is not that there's not customers in China, there's customers in North America, there's people alive that need things. But everything got so overpriced because consumption was at a 5% GDP, world GDP level, based on credit consumption. And now that we're in the delevering phase, growth is something like 2% or 3% globally. That's the reality of the situation. And that's not the end of the world. But if you're waiting for prices to come back to the peak levels, I think you're doing yourself a great disservice. I think it's important to understand that that was probably the peak of commodity demand for a while, probably maybe 10 years. That's what commodity cycles tell us. And it's not that there won't be more people looking for that stuff and more products made, but not at the fevered pitch that we saw back then. And I think the quicker we understand how that credit cycle played out and now what we're likely to see for the next 10 years, the more effective you can be at managing your risk, being realistic about your business models, and figuring out how you make a go in this leaner time.
So applying what you've just said to an investor who's locked into the junior resource market here, what are you telling them?
Well, they've been hurt again by being locked in. If you're, it depends who you are in this. If you're a corporation that's trying to get capital because you're building mines or you're, bringing product to market, that means that you're looking for capital. You need it throughout the cycle. The mistake of some business managers, though, is to say, well, we need oil to be $100 a barrel for this project to be sustainable, and we believe it will continue to be $100 a barrel. Well, what's your fallback plan? What if it goes back to $45 a barrel, which is, by the way, the long-term trend of support? Junior resource companies are back to where they were at the start of this escalation cycle. Many of the inputs have already come back down. So if you're banking on everything decoupling and your particular sector staying up while everything's coming back down, I think it's unrealistic. So I think for investors, you don't want to have a dogmatic position. You don't want to say, I've bought, I'm holding indefinitely, I don't care what, because to me, that's unrealistic, because most people, once they lose 30, 40, 50% of their capital, then they panic. Then they do the wrong thing, they sell at the wrong time, and they leave when prices are the best. So you really have to be embracing the idea of these cycles so that you know when to pull back some profits, build up some cash, wait for another great opportunity. And it's quite possible to do, by the way. It's not necessary to just strap yourself to the front of this roller coaster and continue to go. It's kind of like manic behavior if you think about it.
Well, I mean, I've heard and read you, in terms of some of the things that you've written, that preserving capital is number one, given the volatility, given what's going on right now. So what should an investor do?
Well, right now, through this secular bear, we haven't had a negative year in our asset management company. We've had years where we didn't make a lot compared to the overall stock market,
Sure.
But over time, we've made many percent more and retained it for our clients. So all I'm saying is it's not necessary to be fully invested. Buy and hold doesn't work, secular bears. So you do need to go to cash with a portion of your money. Basically, stocks all trade together. Commodities tend to trade with that, thanks to ETFs and indexes. Many of the things that have come up in the last few years have made everything correlated. So you can't hope to hold on to risk assets without a hedge, or you need to sell them and build up some cash. So high quality bonds are a decent place that we've been in the last couple of years and made some great gains. The US dollar is a safe haven in this type of climate. It's negatively correlated to commodities. Canadians can go there with 20 or 30% of their portfolio, US dollars, US T-bills, and actually make 10, 15, 20% while everything else is falling. So it's totally possible to do. And then you also have liquidity when everyone else is panicking to step in with your buy list, which hopefully you've made before. Mm-hmm. Hopefully you've got your buy list ready before the big sale comes, and you go, I'll have 10,000 of those, and you kind of just pick it out at the right price, but you have to let price come to you.
Okay, I have two quick questions for you. Quickly, your take on gold. Where's it going?
That's a wild one. I mean, one of the charts I've got in a presentation is that gold's now below its 3-year trend line as well. And if I'm right about this commodities overlay and this hyper spending that went on in the last 3 years as governments tried to, the bailout mentality, if I'm right that we're at the end of that bailout mentality, gold may indeed be in for a pretty significant correction, because let's not forget that most of the rationale was that paper currencies were going to be indefinitely, especially the US dollar, indefinitely printed, indefinitely devalued, and that gold would have to be the only currency. That may not be the case going forward if we get this fiscal shift in the United States, in which case people might be surprised that gold, long-term support for gold's about 700, and we're 1600 at the moment. So it's hard to say. If we get another round of,
So you're a bit contrarian in this, like to a certain
Yes.
extent, in terms of the folks who are here.
Right. Well, people always believe what's worked for the last few years to be indefinite.
Will continue to work.
Right. And that they haven't made money in gold companies for several years now. I'm just saying, I don't know. We got a big pop on Friday in the price of gold because I guess there was a belief that you might get a bunch more stimulus coming. And indeed, the Federal Reserve may announce another round of stimulus sometime, between now and the fall, and gold may respond with another pop. But if that doesn't keep up, then I just question the overall thesis
The validity
of
it,
how
right.
long that metal can continue to go. I just don't believe it's indefinite. I think there's always an end to a cycle. Gold's been in an uptrend for about 10 years, and that tends to be about as long as these things go on. So we'll see.
Okay, one final question for you. I think this is really fascinating. On your website, back in January when we had you on, you had a little banner on there that said you supported the Occupy movement. It's not on there anymore. The Occupy movement has kind of faded into the mist of time to a certain extent, but the sentiments behind that are obviously still out there.
Yes.
You are obviously still a supporter in terms of where they were going.
Yes.
Just maybe explain that for a bit for me, because I'm sure there are a lot of people that look at the sort of advice that you give and think there's a bit of it's an interesting dichotomy there.
Why? Because I support the
Yeah.
rule of law and democracy and accountability, and I believe that at its tenets, in the basic ideology behind that movement, it was a sense of unfairness, a sense of certain people
Crony
in the
capitalism.
crony capitalism, the banking sector being above the rule of law, not being prosecuted for flagrant frauds, which have still not been prosecuted.
Sure.
And there's a misunderstanding, I think, between the baby boomer generation who are, going on to their retirement years fully expecting that everything be paid to them, and the younger people coming behind who are like not well funded, don't have access to great jobs, don't have the capital to buy all these properties. And I think that disconnect is very important to understand the dynamics of where we are today. And there's obviously radical movements or radical parts to every movement. One of the things I'm most proud of about the Occupy movement is at the beginning everyone was criticizing them for being, young and idealistic and not very organized, and that's probably all fair comment. But they attracted a lot of very savvy, intelligent people who know exactly what, for example, rules should be brought in. And they have put forward some very meaty proposals to agencies like the SEC, to the federal government, to say, here's the rules you actually do need to implement. And so I think they moved from a bunch of, 20-year-olds in a park to attracting enough people with direction to say, yes, this is actually valid, and you do need to think about some of these changes. So I totally support it. It's just that I took the banner off because a couple of people were sending me some questionable material and calling it Occupy, and I thought, it's not an entire movement that I endorse.
Sure.
It's the substance that I just expressed,
Right.
and I think it is entirely valid. And I hope they keep up pushing the puck up the ice in that particular department, because the status quo and the lobbyists have been occupying Wall Street and Washington and most governments around the world for years now. And we have to get back to voting people. Democracy has to have a say. And that's why I think it's good.
It was a movement that was it was leaderless to a certain extent, and by design. But do you have any ambitions? Because, obviously there's a passion there that you have for it. And this is let's face it, this is a movement that I think to really push its ideas forward needs some identifiable leaders.
Yeah. Well, I actually think that I help the cause in what I talk and write about all the time. I'm very proud of my work. I don't have all the answers, but I know the right conversations to have. I know where the problems are. I'm a student of history to be informed about what worked before when we had this similar set of problems in the 20s and 30s, and we had to put some rules back on the road and make people accountable. And I just think that stuff is a no-brainer. It's quite simple. You don't need to have a ton of regulation. You need to have people accountable. You need a bank lender to care if the client pays them back. You need to have risk managers and risk sellers separated. You need depositors to be protected at banks, but not the proprietary trading side where they want to swing for the fences. There's some very obvious stuff. It's not hard to fix. And we just need to get enough people insisting that can be fixed. And then I think we'll get into another fantastic boom period. And I'm actually quite excited about that.
Well, listen, so much more to talk about. We're over by about 10 minutes already. But anyway, look, I appreciate your time and look forward to the next time we have you on.
Great, thank you.